if I'm a betting man and I'm managing money, which I am, we use this rally to raise a little bit of cash, got rid of our losers. We did some tax loss selling, repositioned our portfolio a bit. And so we're kind of expecting here a little bit of a pullback, 100 points, 150 points, something like that on the S&P. And then we'll put that cash back to work for year end. And look, if we don't get it between now and the end of the year, we're going to get a correction at some point. The only question is, from what point is that correction and where does that correction go to? That's just a function of time.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back here at the end of another week for a weekly market recap with my charismatic good friend, portfolio manager, Lance Roberts. Lance, how you doing?
Doing good. It's a Friday, get ready to wrap up for Christmas here soon. So can't be too upset about that.
Yeah, and folks, that's a subtle reminder Lance is giving me here that he's got a constraint here on the back end of this recording because he's got the holiday party for RA advisors. It's a very diplomatic way of you reminding me to get to the point quickly in today's video, Lance. I will, but in one quick second, I picked charismatic as the word for you, Lance, because it is true for sure in spades. But apparently the word for the year, I can't remember what organization picks like the new word for the year. It's one of these sort of dictionary, nonprofits. But the word was Riz, R-I-Z-Z, which is short for charisma. So it's nice. Like, that guy really, has risen me up or whatever. He's got the Riz. So anyways, Lance, you got the Riz. Let's see your Riz on display today.
So what you're telling me is we've now gotten to the point in the English language that we no longer use whole words. We're now using slang as words of the year. Great. I love this.
I had the same initial thought, but then I thought, what? That's what the last generation said about the one coming after it, and then their parents said about them. It's just we're just going to end with, snarls and grunts, basically, at the end of the day.
Exactly. I'm just going to start using all the slang my kids use, like bet. So
I don't even know what that means. And I got kids.
Yeah, exactly.
All right. Well, look, okay. So here at the end of the year, the week kind of bounced around a little bit this week, the markets, but S&P basically looking like it's going to end the week more or less where it started. Lance, you have talked about expecting some softness in the market before it races off to maybe even new highs by the end of the year. You have also said that could happen, or the other thing is that we could do is just grind sideways for a long time to burn off these overbought conditions. Seems like we're kind of in the grinding sideways right now. Are we indeed burning off the overbought conditions here?
Barely. Here I'll just share our weekly chart that we always kind of look at, so we can all be on the same page. So two things are important right now. So first of all, the markets has really gone nowhere. We've just kind of been trading sideways now for a couple of weeks. We go up, we go down, we go up, we go down, really not going anywhere. The overbought condition is coming down very slightly here. We did trigger a MACD sell signal, which does suggest that when you get these sell signals, it doesn't necessarily mean you have a big correction right away. It means you either get these consolidative moves or you do get a correction of some sort. But really what it means more than anything else is, particularly when you're triggering it from a fairly high level, is it just upside is likely contained a bit. We may go up a little bit, but just not a lot. One interesting thing, and on Wednesday was what we call an outside reversal day, and that's where the market opens higher than it did the day before, but then closes below where it opened the day before. And the last time that we had a outside reversal day, we've had these before, but the last time we had it where we were both on a MACD sell signal and overbought, had that outside reversal day. The next 2 days were actually positive. We went almost all the way back to where the outside reversal day occurred, and then you had the correction. And it's interesting because we had this outside reversal day, the markets rallied back to where it was at on that day, and so the question now becomes, next week, do we start getting a little bit of a sell-off heading into Christmas, as everything kind of just kind of gets repositioned for the end of the year kind of closeout? Maybe we will, maybe we won't. One important thing to note that today is the buyback window for corporate share buybacks closes today. We had one of the largest, and the month of November was one of the largest months for corporate share buybacks on record. And with that window closing, that doesn't mean that the world's going to end tomorrow and have a big correction. But you are taking away one of the buyers that has been supporting this rally over the course of the last month. More importantly, if you just take a look at equity fund inflows as a function, those have been declining rather rapidly. So we had a big surge in the month of November with money flowing into equity funds, not surprising. And now you're starting to see that pace of new money coming into equity funds beginning to slow rather rapidly. And that just basically, as we've said before, just suggests that buyers and sellers have kind of met a point of equilibrium. And so what you need now is some event, catalyst, whatever it is, that brings sellers kind of out in force, and then that allows the market to correct. What could that be? Next week is the Fed meeting on Wednesday. We've got the inflation report on Tuesday. If the inflation report comes in hotter than expected, we saw the employment report on Friday. Wage growth came in at 0.4% versus the 0.2 expectation. So again, hotter than expected. The unemployment rate fell to 3.7. That was better than expected. So it still suggests that the economy is doing fine. Wages are going okay. Discretionary incomes are fine, which gives us the economy the ability to continue to kind of run along here, which does provide pressure for inflation. So if we start seeing the idea that maybe Fed, one of the big catalysts behind this rally since November was that the Fed was going to move rate cuts up until the first quarter in March of next year. If we start to see that get kicked out a bit from a little bit hotter than expected data, that might weigh on the market short term, give you a little bit of a correction to buy into as we head into next year.
All right, so a lot to talk about in there. Let me just talk about the end of the year here for a second. So you have said what's in the past, what you thought was the more likely path would be that we'd get some sort of pullback weakness here in the first half of December. And then because of all the year-end shenanigans that go on where all the funds basically have to first sell their losers and then window dress, buy all the stocks that have done well this year, that there's going to be that surge in buying power. And yes, the buyback window is shutting, but we already knew that. That's not necessarily news to the market, right?
That's right.
So do you think that's still more likely, or given sort of all the special conditions that resulted in one of the best Novembers ever on record for both stocks and bonds, did we pull the Santa Claus rally in? Did we already have the rally?
Yeah, that's funny. That's the subject of my newsletter this weekend, which you find on the website for free at realinvestmentadvice.com, along with all of our videos and more.
We need to start having a weekly market recap bingo on which topic I'm going to mention that you're going to say, oh, you know what, funny, I'm writing an article on that. The problem is I think everybody would win. Every single combination would win.
This weekend, we're actually just, exploring that idea. Did we pull it forward? And the answer is probably yes, to some degree. We may have again, and a lot of this will depend on what the market does over the next couple of weeks. So, if the market actually corrects next week and going into Christmas, and we do see a pullback, and say we get a pullback, say 4,500-ish, or even like 4,450 on the index, that's not that far away, by the way. That's just 100 points or so. Then yeah, that gives the market a better ability to rally into year end as portfolio managers window dress, et cetera. If markets just hang around here and do nothing, which is possible, they could even maybe grind their way higher a little bit. That still doesn't necessarily preclude a year in advance. It's just going to limit it somewhat because, again, you never had that kind of reset to kind of work off this kind of equilibrium that we're talking about between buyers and sellers. The Santa Claus rally is the last 5 days of December and the first 2 days of January. So that's that 7-day period that we're talking about for trading. And that starts the day after Christmas. So we still have 2 weeks. So, next Friday is the 15th. I'm looking at a calendar, so if that's why I'm not looking at the camera. The following Friday is the 22nd. And then we have Christmas. And then basically we're going to New Year's Eve on the 29th. So, the next 2 weeks leading up to the 22nd, that's going to be the window where if there's going to be a correction, it's going to happen in that window. If not, then this market's going to try to do whatever it wants to do. I mean, there's a lot of things that suggest that we don't need a big correction at this point. We had a big correction, obviously, in August, September, October. Market was down 10%. So we had this outsized rally in November that was up 10%, but basically up 9% in November. So we've kind of just set ourselves back to where we were back in July. It's now as if the summer sell-off never even happened. And so now the question is how much further can we push the markets without some sort of reset? It's possible markets can stay overbought longer than you think, but if I'm a betting man and I'm managing money, which I am, we use this rally to raise a little bit of cash, got rid of our losers. We did some tax loss selling, repositioned our portfolio a bit. And so we're kind of expecting here a little bit of a pullback, 100 points, 150 points, something like that on the S&P. Then we'll put that cash back to work for year end. And look, if we don't get it between now and the end of the year, we're going to get a correction at some point. The only question is, from what point is that correction and where does that correction go to? That's just a function of time.
Okay. And part of the spirit of the question is just to say, I think folks have a general confidence every year that the Santa Claus rally is going to happen. I think you were generally confident about that. I'm going to guess maybe you're less confident now that it's going to happen. Not that it's not going to happen, but you're now opening yourself up to the potential that, hey, maybe we actually already got this sort of year-end surge early, and you're remaining defensive because you think at some point, there is this correction that's going to happen at some point. Probably a mild one, but
no. Look, whether or not we get the Santa Claus rally, quote unquote, is again, you have to put your expectations in line. I still think we're going to get a Santa Claus rally, right? It was just the difference is that if we had a pullback that gave you a decent entry point, then your Santa Claus rally could be 2-3%. If you don't get a pullback, maybe your Santa Claus rally is a 1% rally, something like that. So it's just basically degrees of what you expect the rally to be. Ultimately, at the end of the day, these why markets rally or they don't rally. We have the January indicators. You have the NFL indicator. The football indicator. Whoever wins the football game. All those. It's like so goes this. So goes the year. Those are all just kind of things that occur within the markets, and ultimately markets are going to trend higher. 85% of the time, markets are going higher. 15% of the time, they're going lower. So the odds are just in your favor that if you're invested, you're going to make money, regardless of everything else that's going on. Odds are you're going to make money. So all we're trying to do is say, look, markets can't go straight up and they don't go straight down, just like we saw in August, September, October. And remember back, we go back to July, actually early June. We started writing about this very same thing. Markets are very overbought. We're going to have a correction, 3 to 5%. You and I were talking about this. We're going to have, it could be as much as 10%. And then in July, we got the correction that started, and went August, September, October, 10.3%. And it was the total sell-off. So, right there at that limit. And so here we are again. We're back to where we were in July and saying, hey, we might get a correction here. And that's just a function of the nature of the markets. They're going to correct. It's just a question from where do they correct and where do they correct to. Markets could go higher, then correct right back to where we are right now. And your risk reward point for putting money to work will be better then than it is today, even though you're at the same point.
Right. But because steam would have come out, and you've mentioned that in videos past. Okay, great. And just to put the last nail in the coffin on this, and the point I was trying to make is, unless the markets pull back in the relatively near future, you don't expect the Santa Claus rally, or the Santa Claus rally is looking to be more and more of a non-event the longer that we just sort of hang out here.
Yeah, right? It could just be a mild. It could be a mild rally. It may not. And look, this market can do anything. Don't go.
We're talking probabilities. Yep.
Yeah. Don't go hang your hat on whatever it says. Like, well, Anthony said it's going to be a 1% rally, so it's not even worth chasing it. This market can surprise the heck out of you because there's still a lot of money sitting around on the sidelines. There's a lot of cash. Portfolio managers are underallocated to equities. They've got to catch up. They've got to have money, in the right stocks, but they better have Google and Apple and Microsoft, NVIDIA, AMD. Those stocks better be on their books at the end of the year, or they're going to get, they suffer a career risk. So, don't discount a stronger rally than what you think could happen.
Okay. All right. Well, I'm following this path because I've got a bunch of elements on what you just talked about lined up here. One of which is this chart right here, which is basically the financial conditions index, which is the blue line here. And as it decreases, that means that it is loosening, right? And then you have the federal funds rate, which is in red there, which they're at odds with each other, and they have been for much of the year, and they are continuing to become more at odds as time goes on, right? And this is really interesting because we've got the Federal Reserve that's been hiking the federal funds rate and trying to tighten conditions, but the markets aren't necessarily going according to script here, right? And so you talked earlier about the surprise today in the unemployment rate, right, where it came in 2 points lower than expected at 3.7%. Wage growth was higher than folks expected. That may add some upward pressure to inflation. We still have sticky inflation in a couple other areas. So all of that potentially gives Powell more air cover to continue the higher for longer campaign that he has been saying he's doing anyways, right? And of course, that could maybe disappoint the market as the market maybe, depending upon especially what the Fed says next week, the market may need to readjust its expectations for when the first rate cut's going to happen. And if it pushes that out, that's another factor that could bring stocks down here. So I guess I'll take a pause here and let you comment here on how important is this continued growing disconnect between monetary policy and financial conditions?
Well, no, look, I've been writing about this for the last, in fact, that was the subject of last weekend's newsletter on the website as well, is, these looser financial conditions, it's a problem for the Fed. The whole reason the Fed hikes rates is to tighten financial conditions to bring down economic activity. And so, we go back to 2010 and we talked, I can't remember how many times that you and I have talked about this, but Bernanke said, hey, we're doing QE to boost asset prices, to boost consumer confidence, which will help the economy grow, right? And so when financial conditions loosen, consumer sentiment improves, they go out and spend money that maybe they have or don't have, but they feel okay because their 401k has more money in it or their IRA has gone up in value. And so they feel better about taking on more credit or more debt or whatever it is because, hey, everything's fine. The markets are doing good. Economy's good. My job's okay. That's not what the Fed wants. And, if the Fed is actually going to stop hiking rates, they need to see, and again, go back to what Jerome Powell said at the last minutes that came out. He said back in October, when they had that meeting, they said, look, the yields on bonds and the stock market are doing our job for us, right? So stocks were down, yields were up, bond prices were down. Everybody was bearish. The whole world's going to hell in a handbasket at that point. And, it was all about, remember, it was all about, it's nobody wants our debt and it's a deficit and it's all this stuff. And then, and so that was the doom and gloom scenario. And so Jerome Powell says, hey, great, this is awesome. Everybody's so bearish. They're not going to go spend money. That's going to help bring down inflation. We don't need to hike rates anymore. Except now, when they came out and made those minutes, since they made those minutes, everybody's like, oh, wait, inflation's coming down. The Fed's going to cut rates, in the first quarter of next year. This is awesome. Let's go run up stock prices and go run up bond prices, bring yields down to, we were at 4.1-ish% yesterday on the 10-year treasury. Let's do all that. What's happened since then? Mortgage rates have come down. Mortgage applications have gone up. Consumer spending is going to probably show an increase in improvement. We're seeing LEI indicators bottom and start to turn up. I mean, it's everything you don't want to see for slowing down economic growth, which is really going to put and this is what I've been saying for the last, couple of newsletters, is this puts the Fed in a really tough position of coming out at this next meeting next week and saying, yeah, we're done hiking rates. I mean, I seriously think Jerome Powell is going to stick to his gun next week and say, we can still hike if needed. We don't, we're watching the economic data. We're still concerned about inflationary pressures. We're not seeing what we need to see, to call the coast clear. That's not what the market wants to hear.
All right. So Powell's going to come out and basically say, don't you think I won't stop this car? Don't you think I won't turn around if you guys don't stop partying in the back?
And look, and he may not. He may just stick to his same speech that he had, Thursday before or last Thursday. which basically said that. I mean, basically he said we're not done yet.
I will turn this car around, young man.
Yeah, but again, but we go all the way back to 2022. Markets would rally in 2022, then the Fed would come out and say, "Hey, we're hiking rates some more," and then the market would sell off, and then markets would just kind of arbitrarily think, "Oh, I think the Fed's done hiking rates here." Start rallying again, then the Fed would come out and say, "Nope, beatings are going to continue until morale improves. You're not listening," and then we'd sell off again, right? And this has been the case for the last 2 years, really, in this market, and it's a function of what the Fed trained the markets to do over the last decade. What we should be seeing is investors afraid of owning long duration assets because earnings, inflation, economic growth, those type of things are at risk. But we don't see that. What we see, remember back in 2022, when the markets were selling off, I kept talking to you about, we've got a ton of FOMO in the markets. Every time the market sells off, I start getting phone calls like, is this the bottom? Is this where I need to start buying equities? And I need to jump in now. And we've now trained investors that every dip, they've got to be buying equities. And as soon as the Fed cuts rates, that's going to be awesome for equities, because that's going to loosen monetary accommodation, and stock prices are going to run up, because we train them to do that. It's like Pavlov's dogs. For the last 13 years, we've been training them that when the Fed rings the bell, buy stocks. And so this is why every time the market gyrates a bit, you get this FOMO rush of investors running back into the markets, trying to hopefully catch the bottom. And that has some good consequences. It has some bad consequences. But this is just a function of the new dynamic of the market that we're in, and markets are trying to fight the Fed tooth and nail all the way to the end game.
Yeah, and what's so interesting, we've talked about this a lot, is at every point in time this year, the market has had to be the one to blink in this game of chicken, and yet it hasn't mattered, right?
That's correct.
Stocks have continued going higher. Now, I want to bring one thing up here. Okay, so you can see here the last time these two lines touched, right? The Fed funds rate and the financial conditions index, meaning that they were still somewhat correlated, positively correlated, was in April.
That was the last Fed rate hike.
Well, and also what that was the banking system, scare.
Actually go back to that. That's Q2 you're clicking on, I think. Which would be June. That's June.
Let's see here. Let me. Yep. Sorry. Let me just.
Q1 would be January, February, March, April, May, June would be Q2. Yeah, that's Q2.
Okay, but yeah, Q2. But basically, right after that, we start sinking. And here's the point I want to make, which is what happened in late March, April, and then onwards. Right, we had the BTFP. Right, we had the liquidity coming in to help rescue the banking system. We have also so basically what I want to say is you're right. The Fed totally conditioned the market that it was always going to backstop things, always going to be there, right? It was always going to play savior. But the other thing that I think this could be indicative of, Lance, which you and I talk an awful lot about, is liquidity, right? There are times where we've sort of thrown up our hands and just said, hey, does all the pontificating really not matter, and all we have to do is just watch net liquidity flows? Will that just basically tell the tale? And that is a pretty compelling argument. And so we had this year, we had the BTFP launch right around then, right? The last time when they started to deviate. We've had the reverse repo market getting drained, which I want to talk with you a little bit about in a bit. And so, like I literally just got a DM this morning from Sven Henrik, a very exasperated one, just saying, hey, remember back in March where we just said it's really all about liquidity? He's like, I think it's the same thing here. That's just driving everything around here, right? So I do want to note that I've got Michael Howell, who I interviewed at the very beginning of this year about liquidity. He tracks that very closely. He's got his own sort of special way of measuring it. I know you do too as well, Lance. But he's going to be on this program in 2 weeks, I think, folks. So we'll get an update from him on what's going on there. But my question to you, Lance, is despite the monetary tightening, with these different vehicles, the BTFP, draining the reverse repo, all the deficit spending that's been happening this year on the fiscal side, could that be just sort of explaining too this discrepancy here, where the conditions are just getting looser because there's a lot more sort of shadow liquidity out there than most folks realize?
No, absolutely. And we federal expenditures continue to increase. I think we did this chart here. Let me think I've got a chart of it. Yeah, I've got a chart right here. I think we talked about this last week to some degree, that, federal expenditures, regardless of, everything else that you think is going on, has just continued to increase. So this is,
yeah, that's right. Yeah, pull this back up. And as you're talking to it, just see if you can address the question of, will Powell stop his tightening campaign while conditions are this loose, right? Or will these conditions need to tighten to be able to give Powell the ability to finally win the inflation battle?
No, that's the $1 million question. I mean, I've been talking to a lot of people lately. I just had a conversation with, a very notable economist this morning, and who's coming down to speak, at the event in January that you're going to come down for. He'll be there to talk about, next year and, what to expect. But he's like, look, he says, when you take a look at the economy is doing just fine. And there's plenty of liquidity still in the system. People still have money to spend. Yes, it's tightening up, but there's still, excess savings. There's still lots of monetary liquidity coming in from different angles. There's a lot of money sitting in money market accounts right now. So there's dry powder, so to speak, to help support spending and economic growth. But also, too, just federal expenditures. We're running a $2 trillion deficit, and we're not really in a war. I mean, yeah, we've got some wars going on that we're helping fund, like Ukraine and Israel, but we're not directly involved. We're not directly involved in a war effort at the moment, and we're running a $2 trillion deficit. So, that's just all this other spending that we've got going on inside of the government that continues to feed into economic growth. And that's what this chart is. You see kind of see the real gross domestic product. We just clipped 5.2% growth in third quarter. Now fourth quarter is going to slow down, and that's kind of what we expected. But it's still running probably 1.2 to 1.5, somewhere around there. So still have positive growth, and that's just because of this, continued increase of federal spending that we've got going on. That's just moving into the system. So you take a look at M2. As a percentage of GDP, it's still extremely elevated. We talk about that pig in the python. There's still a lot of pig left in that python that hasn't come through yet. And so, will it eventually come out? Absolutely. Is it going to be in 2024? Maybe not. Maybe, the real slowdown occurs in 2025. Maybe it's 2026. We really don't know where the end of that runway is, because we keep coming up with new ways to spend money or find money or whatever it is, right? Interesting. Speaking of that, we talked about consumers, right? Good example. There's an article out this past week, took a survey of all these buy now, pay later firms that have sprung up since 2022-ish, right? After the pandemic. Yeah. Those have record borrowings right now. People are flooding to these buy now, pay later firms because, you can buy something, you make, you have payments over 4 or 8 or 12 months, whatever it is. And, that's just a function of people, again, talked about, before, consumers are very adept at finding new ways to get access to money. And so they're fleeing, they're kind of flocking. I can't get any more of my credit card, so I'll go take it out on these buy now, pay later programs.
Yeah, and I'm not even sure we should make that assumption, because that's my initial assumption too, is, oh my God, people are so desperate, all they can do now is the buy now, pay later stuff. But buy now, pay later, I think people might be choosing that over putting it on a credit card, even if they have a credit card option. And the reason for that is buy now, pay later, it doesn't charge, it charges you, I think, lower financing fees than most credit cards do. Now, the problem is if you miss a payment, then the penalty fees that come into that can be pretty rapacious, right? But I think it's consumers just following the incentives, right? Where it's like, oh, it's cheaper borrowing that I don't have to actually pay today. Great, I'm going to do it. I think it's a massive ticking time bomb. I think that, we're going to see in a year or two, a lot of these buy now, pay later companies be in real trouble, if not go out of business. And folks will say, my gosh, that was a terrible idea. How do we ever go along with it? But right now, people are just being people, right?
Yeah. But that's my whole point. It doesn't matter why they're doing it. It's a function they are doing it.
Right.
And you take credit card, the ability to take out credit cards, those are reaching limits where, we've seen just a massive surge of that. So, but again, this has been my whole point for a while, is don't count the consumer out, right? Inflation's high, housing prices are high, gas prices are high, whatever. But man, consumers, They're built to spend, and they're trained to spend money, and that's
So-
all our society is built around, is go spend more money.
Okay, so this is a great point, and it's not just consumers; it's the whole system that is trying to preserve the status quo. So that's what you're going up against if you are taking the contrary position, which I generally am inclined to take. But I agree, we got to be very, very cautious right now about the assumptions we're making. And what's so interesting about this, Lance, is there are probably two things that the people I bring on this channel now, I'm seeing. They agree about a lot of things, but here are the things I think they disagree on the most. One is what's going to happen with bond yields next year. That's number one. But the second one is this: are we headed, into a recession? Maybe we're already in one. Versus, hey, things are actually chugging along better than a lot of people are giving credit for, and this economy and the consumer could be stronger for a lot longer than many people expect. So I just interviewed in two great points, my past two interviews on this channel, Danielle DiMartino Booth, she's much more worried about deflation next year and recession, all that federal expenditure that you were just talking about, Lance. She thinks the two things. One, she says, look, the money that really matters is the money that's been going directly to consumers and getting directly out in the economy. She's like, that spigot is fully shut off. And going forward, the fiscal spending is going to get harder because Congress is becoming even more divided. And new Speaker of the House on the Republican side, they're going to do everything they can to try to thwart, the administration going into next year's elections. Then right before her, I interviewed Wolf Richter, who publishes a ton of data, a lot of charts on his website, and he said two things. He said, first off, I think we need a recession. He's like, hands down, I agree we need one. They're healthy. We've been putting it at bay for way too long. We need a recession. But he's like, I just don't see it in the data. And he said the consumer is actually doing really pretty well when you look at recent increases in wages and how consumer spending is holding up. And I was pushing back on certain things like the explosion in revolving credit. And he's like, yeah, but you know what? The majority of that gets paid off every month. Not that many people are carrying balances, which, by the way, folks, led to an explosion of emails to me. And I went back and forth with Wolf on it. He's got a couple of really interesting articles on his wolfstreet.com. If you want to dig more deeply into the data behind that claim that he made, there is a logic behind it. So you can go to his website and check it out. But basically, Wolf is just saying, I'd be the first one to say, I think there's, a recession coming if I saw it in the data, because I think we should have a recession. But he's like, I just don't see the worrying signs yet. I don't see the defaults yet, right? The subprime has a little bit of problems, but it always does. That's why it's called subprime. There's no major toppling dominoes right now that makes him think a recession should happen in the first half of next year or longer, right? So to your point, Lance, we just need to be cautious about, whatever.
Yeah. Look, there's a ton of data out there that, let me back that up. There's a ton of indicators out there, inverted yield curve, leading economic indicators, et cetera, that all say a recession is going to occur. And we've written about this before. And, the problem is always the timing. And there's so much, again, I agree with Wolf. There's so much money in the system, no matter how you break it down. You look at M2, you look at GDP, you look at, household savings rates, those type of things. There's so much money sitting out there that, it could potentially, as I said, we may not get a recession in 2024. It could be 2025. It could be 2026. It's hard to imagine. You're like, but Lance, these indicators say are always right about a recession. And that's true. They are until they're not. And, look, they've never been wrong before, but it doesn't mean that this time, because, and again, the way you have to look at this is that what we did in 2020 was so abnormal, right? We artificially shut down the economy. We created a recession in 2020. And then we just flooded households with cash. We've never done that, right? We never sent $5 trillion worth of money directly to households and then provided all these other benefits and add-ons and everything else. So we've skewed the data so badly that, when you start looking at things and going, well, we should have a recession, you got to be a little cautious with that. Let me give you a good example here. Let me see. Hold on a second. Let me just grab this chart real fast, because I think this will help kind of explain a little bit of why everybody has this conundrum going on right now. Look, I'm right there with everybody else. I'm like, this doesn't really make a lot of sense, but this is exactly what should be happening. We should be having this recession, etc. Bear with me 1 second here. Let me get this chart.
Sure. Well, as you're pulling it up, I'm going to ask a question that maybe you can address in your answer as you speak to it, which is, you use the rubber band analogy an awful lot, right? So if we dramatically, if we pull the rubber band further than we've ever pulled it before, right? It should snap back at some point. And my question is every snapback, it doesn't just snap back to the average. There's usually an overcorrection, right? So should we expect, if we had unprecedented record stimulus, should we expect at some point, maybe not next year, but at some point, an unusually large period of slow growth because we overstimulated so much? Like, do the scales need to balance like that?
Yeah, and the question though is at what level do they start to balance? And so this is my point. So take a look at this chart. So this is GDP quarterly change at an annual rate, right? So this is how we measure GDP. So 5.2% growth in Q3. We didn't really grow at 5.2%. That's taking 1/4 of that number. That's what actually occurred in Q4 or Q3, and then we multiply it for a year. So we multiply
annualize it. Yeah,
that's the annual rate. So that's what this chart is. So you say, well, we've got to have this recession. Okay, well, what's a recession? That's negative annual growth. Okay, that's a recession. But we have to go back and look at this spike that we had follow 2020. So in March of 2020, we shut down the economy. The economy drops by 8% at an annual rate. Then we flood the system with this liquidity, and the economy surges 12% at an annual rate, right? So that's a 20% reversion in GDP with all that money, right? So we had this massive surge in economic growth. Well, we've now corrected a big chunk of that. We almost got back to 0% growth, before this little rally at an annual rate. So we've actually declined by 12% growth in the economy. Now, at any other time in history, if we were at 2 or 3 or 4% growth and then declined by 12%, we'd be in a recession, right? But because we never got below 0, we didn't have a recession, but the economy still slowed by 12%. So, kind of in theory, if you're driving along, at 20 miles an hour, and then, you hit a brick wall and you stop, but you don't go through the brick wall, that's all that's happened to the economy, is that we just came to a stop, basically, and have now started to kind of revert that big decline that we had. So again, in any normal time, the decline in economic activity that we saw would have been recessionary. But because we were starting from such a high level, we never actually triggered that recession. So that's the one kind of conundrum that lays out there. And look, I'm not saying that we're not going to turn around and drop into negative territory. It's just we screwed up the data so much with all that stimulus. We've never had a spike like that before. And so reverting that spike has occurred. It just didn't drag into negative territory yet. And I'm not saying that it won't. I'm just saying you have to consider the fact that maybe the recession occurred, but it wasn't an actual recession.
Okay. Let me just get this note down. Lance Roberts says no recessions ever again in his lifetime. Okay.
Exactly. No, that's not what I'm saying.
No. Good point. I mean, it's a good point, right? Which is, we have come down an awful lot from that mountaintop, right? And even though we didn't quite go negative, it's a unprecedented almost drop from 12% to almost near 0%. In fact, in that data series, I don't think we ever saw a drop that much, right? Okay, so a couple of things on this still. One is, I just want to underscore a point I made earlier, which adds to your point about, like, hey, remember, consumers, they're going to do whatever they can. They're going to find all sorts of creative ways to game the system, right, to keep getting money to spend. And so they're going to keep their spending going as much as they humanly possibly can, to the point where, like, people are selling organs and all that type of stuff, right? They can be very, very creative, especially when they get desperate. But on the other side, right, on the policy side, on the corporate side, you just have absolutely everybody who benefits from the status quo laser focused on trying to make sure that the status quo keeps happening, right? So for the recession to happen, the forces have to get big enough that they overpower the collective forces of those trying to keep the status quo going. And that's a big battle, right? That just doesn't happen generally overnight, right? So this thing could, my point is, this could last a lot longer than a lot of bears, myself included, could think possible, right? Not saying it is going to last that long, but it could. Now, let's get to some potential forecasting here, right? I just interviewed Felix Zulauf. Fantastic interview. Felix is great because he's very articulate. He's highly respected because his track record has been phenomenal. And whether or not this is what's going to happen, Felix laid out very clearly what he thinks is going to happen over the next couple of years. Folks, you definitely want to watch that video. If you're watching this the day this video comes out, it hasn't launched yet, but it will launch the next day on Sunday. If you're watching this video a day after it's released, the Felix interview is already out there in the world. You should go watch it. But basically what he says, Lance, is he thinks the economy is going to power higher through Q1. And it's going to look stronger than it does now. And that's going to get people continued excited that, hey, you know, forget soft landing, no landing, we're all good here. And the markets, he thinks, will power higher into Q1. So, you know, he's not making these exact predictions, but he says, I wouldn't be surprised to see the S&P at like 5,000. Yeah. Right. He thinks that's going to be the peak. He then thinks that the lag effects are going to catch up. The wheels are going to start coming off. And he sees the markets declining potentially pretty substantially next year, potentially as low as 3,000 on the S&P. So that's a 40% correction potential in the S&P. Folks, if you want to understand all of Felix's reasons why, go watch that video. But you know, so in his view, the current strength that we're seeing, you know, probably the last fumes, if you will, but they could continue for another quarter or so, probably break a lot of the existing bears' stamina, you know, get a lot of capitulation from them, get everybody back on the like, okay, we're in Goldilocks world now train, only to then pull the rug out from underneath all of them. Not saying that's going to happen, just saying a very smart, very experienced long-term investor, that's his outlook for right now. So to your point, Lance, like it's tricky time, right? Because if you are expecting recession and whatnot next year, you look into the data right now, it does not look like it's coming close. So you may want to play this game for a bit, but there's still lots of things out there. And you gave a litany of them earlier that still show that, hey, there's a lot of recessionary indicators out there, and they very well at some point might you know, come into their full expression and could catch a lot of people who are overextended on the long side. So I understand, particularly, you know, in your world where you have to play this game because you've got client capital to manage, but you got to be prudent while you're doing it at the same time, right?
Yeah, no, that's right. And this is something that, you know, we actually just talked about in Tuesday's article on our website, talking about, you know, looking at next year, and you know, analysts are always very optimistic. In fact, you know, right now you're getting all the Wall Street optimism, you know, kind of out in the markets. I always think it's interesting because I write this article, you know, pretty much every year, and it's interesting because last year we lay out a range of predictions, and we said that based on a multiple expansion scenario, the markets would end at about 45.50, and it's exactly where the markets are. So I mean, almost to the point of what we laid out last year. Has actually come out to be the case. Now, again, there's also bearish predictions in there as well, because you have to account for a recession, you know, margin contraction, those type of things. And so we just went through this exercise again. Here, I'll share a couple of screens with you, you know, as we start thinking about next year. And I don't disagree with what Zulauf is saying, because again, you just don't know what next year is going to bring. But I think it was interesting because this was in 2022. In 2021, going into 2022, Goldman Sachs said that the market was going to climb 9% to 5,100. Now, that was 5,100 in 2021, right? Turned out that the market ended the year at 38.39. So this is why you got to be careful.
Goldman guys get paid the big bucks.
Exactly. Well, no, this is the whole point of the article, which is be careful, you know, who you listen to, because analysts are always paid to be optimistic. And I'll explain to you why. And I just wrote an article about why that's the case. That was last weekend's newsletter, going through you as a retail investor, you should never listen to Wall Street because they're there to sell you product. When you look at who compensates Wall Street, retail is at the very bottom of the list. They can care less about you because all that Goldman wants to do is sell you products. So they're always optimistic because they want to sell their investment banking services to, their clients, which are the corporations, right? So this is the problem with Wall Street.
Yeah,
anyway,
hey, I'm gonna interject just for 1 second. There's an important point you're touching on here too, which is it's not just Wall Street, right? So Wall Street, obviously, right? Their incentive is to line their own pockets, right? But it's the financial media in many ways, and I get this an awful lot from folks who are coming to this channel because they're so disenfranchised and disappointed by the mainstream financial media, because who pays it is the advertisers whose products Wall Street is selling, right? Yeah. So
that's why you see every segment of CNBC, this ad sponsored by Spider ETFs or Alliance Mutual Funds or whatever.
And that's why in CNBC, no matter what the market has done, it's always a good time to buy stocks, right? Exactly. Yeah. So I just want to underscore your point. It's not just Wall Street pressuring you this; it's the media also telling you the same false story, potentially false story. Put it this way, definitely biased story.
Exactly. So Wall Street end of the year targets for this year was an average of 4,000. We're 500 points above that. So again, this is the problem with these, and this is what analysts always think would happen, what versus happen. This is why you have to do your own homework, and you've got to be realistic, and you got to whenever you, and again, this is why I tell you, so if you listen to and look, you just had a really good point counterpoint discussion between Danielle DiMartino Booth and Wolf Richter. Right, Danielle, recession coming next year. Okay, I need to be in the bunker. I need to be all in cash because we have a recession that's bad for stocks. Wolf saying, hey, maybe not the case. So again, you've got to take both of those arguments and weigh them and then make your assumptions. And that's the whole point of this article, is to go through that exercise and say, look, right now, next year, 2024 targets are back to 5,100. What Goldman said basically 2 years ago, we're now going to be at the same spot 2 years later, right? So keep that in mind.
Yep.
Earnings for next year are expected to climb to 220. Now, those earnings have already come down by $7 from the original estimate. So they were even more bullish to start with, but those earnings estimates are starting to come down. But we're still at 220 a share. They'll be up from 184.95. This is according to S&P earnings from quarter three. We don't have quarter four yet, but those are expected to come in right around 190-ish, 190, 191 for fourth quarter. So earnings growth next year, that suggests that stocks should trade higher next year because earnings are going higher. So let's do some math. And this is the point of the exercise. Take everything you're hearing, right, and throw it in the garbage and do your homework. All you have to do is understand valuations at the end of the day. Where do you assume valuations will be next year? Let's make some assumptions. So the only thing we have to work with right now is $220 a share in earnings for quarter four. So we're going to use that as our baseline because that's what we have right now. Those are the estimates. So now my opinion is those estimates are going to come down. We're probably going to be closer to 200, 205, probably by the end of next year, but we'll see when we get there. But assuming 220, if we assume no recession, so let's go with Wolf and say no recession next year. If we have no recession, we should probably estimate that valuations would remain about where they are, about 22 times earnings, which would mean that based on 22 times earnings, the market should trade at 4,845 next year.
Got it. And sorry to interrupt, just interject. 2,200 PE ratio is elevated. I just want to make sure that folks realize that we are.
But it's been about the average over the last several years, right? We've been trading elevated for quite a long time. Mm-hmm. Back prior to 2000, as an example, the average PE ratio was around 13, 14 times earnings. That was the average going back to 1900. Since 2000, we've been trading at elevated valuations. That average PE ratio is now 19, right? So that's just, we've been trading above long-term historical norms for a very long time. So at 22 times earnings, that's about, as you can see, that's kind of about where we've been over the last several years. So in that environment, if we assume no recession, and the economy just kind of chugs along, nothing fantastic, then you're at 48.45. So it's about a 300-point advance from where we are right now. But let's assume a soft landing. So let's assume that Danielle's right, and we have and one of the reasons I say soft landing is I want to differentiate between just a normal recession and a financial crisis. Because when you
Right.
mention recession now, everybody immediately assumes a 50% market decline. We're going to have, everybody's going to be living on the street. And so it'll be this massive financial crisis. We don't have any of the ingredients for a financial crisis.
Right. And you showed that awesome chart the other week that showed the probability of a financial crisis. It's a super tail risk, right? It's like 3% or something like that. Not that they don't happen, but they do not happen often. Yeah.
Exactly. But let's assume a recession. And in a recession, you would expect a valuation reversion back to probably the long-term average, which would be around 17 times earnings. That puts you at 37.44. So there's Zulof's argument, give or take, right?
Yeah.
Maybe a little bit more. It could be a little bit more. It could be a little bit less, whatever. But just assume that's his kind of his thesis. So there's your Zulof argument. And those are perfectly valid, right? If we look at the long-term historical norms of historical recessions and market declines, a decline to 37.44 from current levels would be about an 18% decline. That's well within the norms of what happens during a recession. Could be a little bit more, could be a little bit less, but well within the normality of what would occur during a recession. So if we have a recession, an 18 to 20% decline, completely normal. You should expect that. So we've got two possibilities. We've got a maintained valuation normal, everything's fine, economy kind of grows. We've got a recession scenario. So we've got two outcomes potentially, one bullish, one bearish. Now, one thing that we know is that when the Fed hikes rates and they start to cut rates, that normally markets don't do as well. Maybe this time is different because of liquidity. We'll see. But it's something that we have to certainly consider. But now we also need to step back. We need a bullish scenario. Right, we've got to be thinking, hey, markets always tend to do stuff you don't expect. So let's come up with a bullish scenario and say we have another year like we had this year, where we have a margin expansion year. So what is margin expansion? That's where earnings don't really grow that much. Maybe we go to $220 a share, maybe whatever it is, but we even pay up more for those earnings. We think that the world is doing great, and we're willing to pay even more for forward earnings than what they're really worth, which is what we've been doing for the last 2 years, by the way. So we have to have this margin expansion idea in there, because it's possible the markets could pay up more for an expectation that, hey, it's a soft landing, we're going to get through it, and then 2025 is going to be gangbusters. We're going to be off to the races, profit margins are going to grow, etc. So let's assume that we go from 24 times earnings now to 24 and a half times earnings. Not a big increase in margin expansion, but at 24 and a half times earnings by the end of next year, you're talking about 5,300, 5,400 technically on the S&P. Now, again, this is just based on valuations. I'm not saying we're going to go to 5,400. I'm saying based on valuations, that's where you would expect it to be. And when we did this analysis last year, this was the bullish outcome for last year, and it pegged it right at 45.50, right about where markets are trading now.
Got
so
it. Yep.
You can't discount those bullish narratives. And so here's the point of this whole exercise. We put all this together. We say, look, here's where the market's trading. Now, look, this was last Thursday. I wrote this article, so we don't have the latest price movement in here, but you get the idea. But you put this on a range of outcomes. There's your range of outcomes for next year. Now, how do you build your portfolio to navigate that range of outcomes? That's the only question you need to worry about. All the other narratives are BS. Just throw them out the window. They're not even relevant. Just understand what your ranges are. How do I manage a portfolio risk structured so that I can mitigate my downside potential if that would occur? Felix Zulof is right. Danielle's right. That's your downside. How do I navigate that? But at the same time, how do I also participate if we have these better outcomes than what expected? Because that's certainly what happened in 2023, because everybody thought it was going to be a terrible year this year. In 2022, they thought it was going to be great, and it wasn't. So you have to always, look at what the outcomes could be and manage that risk reward profile accordingly.
Okay. So that is the question. And I know the answer isn't a simple one, and it's kind of different for every client. And again, this is why, I keep beating the drum on this channel to work with a good professional financial advisor who takes all the things that Lance and I are talking about here into consideration. But Lance, as the portfolio manager, can you give us a distilled sense of how you are planning on positioning for that?
Well, this is why we talk about risk management every week. We talk about technicals. We talk about all this. I don't need to worry about what's going to happen between now and December of next year, because nobody knows. That's the whole point of the exercise. Nobody knows what's going to happen. And every year the analysts are wrong. So, and as we talked about before, if you're going, well, I think next year is going to be this terrible bear market, I'm going to put all my money into cash. That's not going to work out well for you. Most likely, maybe it will, but most likely it won't. This is why you just have to manage your portfolio from 1 week to the next and say, okay, what's changing? Is something changing? Do I need to be aware of that? I need to reposition. I want to add exposure. I want to reduce exposure, because you're sailing uncharted waters. Nobody knows what's going to happen next year. Nobody can predict what's going to happen. We just have to sell the waters that we're in and navigate accordingly.
Okay, so let me share two things, because I want to make this really personal for folks too. So one, Felix again goes into much more detail in terms of what he's doing, but given the arc that he laid out there, and we didn't talk about his outlook for bonds yet, and I still want to ask you a little bit about the bonds market too before we're done here, Lance.
Yeah.
But Felix is basically saying he's light long going into Q1, right? So he thinks there's still some more juice left in this market run, but he's not chasing after it aggressively. He's just basically sitting in a lot of short-term cash equivalents that are paying him a nice yield, and then he is going to go short if he starts seeing the indicators that he expects, and he does plan to play the short drop in the market. I don't want to put words in his mouth, but I would say I won't say aggressively, but he'll be in it. He'll be in it to capture some return on that market correction, if it indeed happens. Now, in his mind, though, the big opportunity comes after the correction, the dust settles, because that's when he expects the big central bank rescue, right? And he expects asset prices to shoot the moon over the next 2 years, right? Okay. Largely driven by all the liquidity and stimulus getting pumped into the system. Now, who knows if that's going to happen or not? But that is his playbook, should that happen. Okay, I am running out of time quickly here again, so let me.
By the way, I've got one topic I want to hit on before we finish out. I need about 5 minutes.
Oh God! All right, if you need 5 minutes, then we're going to punt the rant again for yet another week. But that's okay.
This is actually, you'll appreciate this one. This is actually a good rant, because it was a Gallup poll and a Wall Street Journal poll that got me fired up this weekend.
Okay, good. Well, I'm glad you're fired up about it. So real quick, where to start? Okay, first, let me just pull this up here. So I put this out on Twitter the other day, just asking, hey, have we seen the peak in bond yields, right? Generated a lot of discussion. I'll be super transparent with Felix Zulauf. He feels that rates will probably keep heading downward from here. What I love about him is in his predictions, he's willing to kind of be specific about the targets he's looking for. He could see them going down to about 3.7 by Q1 when we're at the peak Goldilocks. He then thinks as we start getting into trouble, he could see yields jumping back up. We're talking about 10-year US Treasury yields here, potentially up to like the 5.5% range, and then potentially decreasing as low as 3% by the end of next year. That said, he's not like going big on the bond trade like you and Mike Leibowitz are, Lance. He is he's saying, there's enough uncertainty in that I just don't want to. I don't want to be put in danger of getting that call wrong. But I know you and Mike Leibowitz again have been, you've been very transparent, and we've talked an awful lot about your bond outlook here. But I'm curious, do you think that the peak in yields is in for the cycle?
Peak of yields is the peak is probably in. There's not really a driver to push yields back up to 5. So again, what drives yields is inflation and economic growth. So unless you get a massive surge in economic growth and inflation jumps back up to 6-7%, then yields are probably where they need to be. When yields were at 5, those were overvalued relative to where inflation was at 3.9 at the time, and economic growth is still around 2.5 to 3. So that all augurs that yields will come lower. But the day before yesterday, I sold it. So I have a personal bond trade that's going on, and Mike has been has a personal trade going on with option calls. Day before yesterday, he closed out his calls, and I sold a third of my bond position. The reason is that yields have come down too far too fast. They're aggressively overbought here, and as we're seeing today, because of this employment number, our assumption is that we're going to get some economic data that comes out stronger than expected. The Fed is probably going to give you some message next week that they're not ready to cut rates yet. That's going to pull yield back up, and that'll give us a better opportunity to add back into those positions, and we'll do that. So we're looking for maybe a pullback to around 4.5, 4.6, 4.7 on the 10-year Treasury, and somewhere in there, then I'm going to buy back those shares that I sold. This is on my personal account, not my client accounts.
Yeah.
So it's clear.
By the way, is Mike pulling into the office in a new Lamborghini these days?
Yeah, no, not yet. But those trades are working very, very well, and I think that as the economy, look, if you're in Daniel DiMartino Booth's camp and you're expecting a recession, buying yields are going to do great because you're getting, even in a slow economic environment, inflation. If inflation gets down to 2%, economic growth goes to 2%, which is what the Fed wants, then interest rates will be 2%. So it's just a bunch.
And just to full transparency, so Danielle thinks that deflation's going to be the problem next year. So she's in David Rosenberg's camp that we'll actually see less than 2% inflation. Maybe 1% handle, or in Daniel's case, maybe even negative at some point.
And if you see that, then the Fed is starting to aggressively intervene. Then yields are going to go to 1% or less.
Okay, so if they're right, that's where we go. To be clear with Felix, where he expects 3%-ish by the end of this washout on the 10-year at the end of next year, he then for the next couple years sees sees bond yields going to the moon, because he thinks that'll be the central bank rescue efforts will be highly inflationary, and that bond yields are going to have to sort of compensate for that.
Yeah, that's not actually correct at all, because if you go back to 2000, no, you just go back and look at a chart between 2010 and 2013, where we did $43 trillion worth of government interventions. The only one of those that created inflation was checks to households.
Right.
So as long as the Fed's doing QE and keeping rates at zero, that's actually deflationary for rates, and that's going to keep rates near the zero bound, because that's what the Fed wants. And so they're going to make sure they push those long-term rates lower. So that's not the worry. Now, if he's expecting the government to step in and start doing MMT again, then yeah, you're going to have inflation and rates are going higher.
Yeah, I think he may be. To be honest, I don't think I pressed into him because I was more focused on the year coming, not multiple years out, because as you've said many times, that's just all postulating. So I don't know exactly what's in his forecast, but I'm guessing it is. Like I agree with you, Lance. You get out too far, nobody knows what's going to happen. But I'm going to let you be the one to call Felix Zulaf wrong. I'm not going to call him wrong.
No, I'm just saying, if he's saying that just Fed intervention alone, which is key.
I hear what you're saying, and Danielle said the same thing. I think we all agree that doesn't get out into the wild nearly have the inflationary effect that direct money to consumer households has. Problem is we've opened that Pandora's box. Yeah, that's exactly what they'll be asking for, right? They'll be demanding that.
And won't matter who's in charge of the House or the Senate. It won't matter.
Yeah. Talking quickly here, because I'm trying to get to your deadline. Talked with the conversation with Danielle, the reverse repo market. And for folks who don't know what that is, we define it in depth in the discussion with Danielle. But essentially, it has been providing liquidity to the system as reverse repo has been basically getting drained. On the current trajectory that it is being drained, it should be basically empty by end of Q1-ish next year. How substantial is that, Lance?
It's an issue. I don't think it's a crisis type issue at some point, because we had a reverse repo issue back in 2019. And this is where, we were doing, rates had gone to like 8% for overnight borrowing, and we were bailing out hedge funds and all those type of things. And then, that all got fixed in 2020 when the Fed stepped in, massive liquidity. So, if there's a warning sign that you're looking for, that maybe there's, and again, let's go back. And this is one thing that Mike and I have been very clear about. If the Fed is going to become more dovish at the next meeting, that is going to be because they see something that we don't see happening. in the credit markets. So if this reverse repo issue is leading to some form of financial instability within the banking system, then we may see them become much more dovish. And that would be a really good clue. If they come out in next week, considering what's been happening with the markets, with the bond market, what's been happening with the economic data, if they come out next week and kind of tilt more dovish, like, hey, you know, we're probably good on hiking rates. We're probably restrictive enough. And they kind of pull that one more rate hike off the table. That's probably a pretty good indication that there's some stress in the financial system that we're not openly aware of. And maybe that's what reverse repo is telling us. But
right. So the markets would cheer that, but a sane person like you and me would say, all right, that actually kind of worries us because it means they're scared of something. Yeah.
Correct. But that also means that we're one step closer to the Fed bailing something out too.
Yeah, but you know, again, everybody thinks, oh, Fed starts the bailout and then asset prices shoot the moon, right? The history shows that no. There are quarters of the Fed desperately cutting rates while the market continues to sink as we fall into recession, right?
Be careful with that, because remember, we've been training investors now for a decade, right? We've been ringing that bell for a decade, and before they're like, oh, panic, something's breaking. Now they're starting. Even we saw this in 2020, right? March 2020, markets are down 35%. We're shutting down the economy, and markets start rallying because the Fed's bailing everything out, right?
Yeah, although I can't remember how quickly they announced all the other stuff too.
It all happened in March. The Fed bailed everything out in March, and by April, the markets are rallying. So
yeah, okay, oh, good, okay. So it might be different this time, given how we've conditioned everybody.
Right. That's all, I'm not saying that's the case. I'm just saying be aware that
yeah.
When we look back at history, yeah, when the Fed cuts rates, you don't want to be long stocks. You want to buy stocks when the Fed stops cutting rates. That's your moment, right? And all I'm saying is that now, after a decade of training people on monetary interventions, they now know, oh, QE, good for stocks. QE, buy stocks, right? Ring the bell, buy stocks. Ring the bell, buy stocks. That's, you know, now we don't have to ring the bell. It's just like, hey, we might cut rates, buy stocks. Yeah. You know, we've just been training people for that now for a decade, and it's now starting to just become habit.
Okay, I think one of the points Danielle was making about when the reverse repo becomes empty is she said that that's sort of been an offset to the Fed's QT.
That's
right?
Right.
And so with that gone, then the full effect of QT is going to start to be felt, right? So
right.
that's and sounds like you think that that's something worth keeping an eye on. Okay.
Yeah, it is. Look, this goes back to liquidity, and why did we have such a big run in the market over the last month? We had a massive surge in liquidity over the last month. So you take the Fed balance sheet minus the TGA general account, reverse repo, that liquidity shot up dramatically, and that all just fed into the market. So, you know, that's, you know, we need to see, if we're going to see another downturn in the markets, we need to see that liquidity reverse.
Well, and that's why I'm so interested about the upcoming interview with Michael Howell, because I want to see what his forecast for liquidity is. Mm-hmm. All right, so I want to get your trades in just a second, real quick. Just want to note for folks that apparently the penalty for underpayment of your federal taxes has more than doubled over the past 2 years. It used to be 3%, it's now 8%. So just noting for folks as we're heading into the end of the year, and you know, last week Lance shared some of the things that you should be doing right now, considering for end of year planning. One thing you should be looking at real closely is hey, have I been making, especially if you are if you're a gig employee, you're self-employed, you receive big bonuses, or you have substantial investment income, and a lot of people have a lot more investment income this year than they've had in previous years. Sit down with your accountant real quick and just do an assessment of whether you may need to be sending some estimated taxes into the government sooner versus waiting later, given these big penalties. Yeah. All right. With that said, Lance, trades. You guys made any recent trades?
None this week.
Okay.
We've already done this is the same as last week. We've done our task loss selling.
Past 2 weeks. Yeah.
Yeah. So we're just waiting for the market to give us some type of correction here that we can buy into.
Okay. All right. So again, waiting for some softness in prices to start deploying more stuff in.
Or just simply time, right?
Right.
Allow the market
let it grind off the overbought.
Right. Yeah. That's all we're waiting. You're just waiting for a better opportunity to put some money to work.
Okay. All right. We got your 5 minutes for your rant here.
All right. So look, last week here, let me just share a screen with you quick. This is an article on our website as of today. This came out actually on Friday. Sorry, came on Friday, and it's talking about the American dream. And this is one of my and Adam and I have talked about capitalism and the benefits of capitalism and those type of things for a while. And I just when I see these surveys that come out, and you see the young generation, and I fear for my kids, because this is really kind of the important point. Is that as I look forward to their future and what they, sorry, let me pause this. So there you go. Millennials and Gen Z have a very poor view of capitalism, and they have an increasing favorability towards socialism. And hey, I get it, right? We've talked about the housing market and unaffordability and all those type of things. And we've created a lot of those problems because of government interventions, because of what the Fed's been doing, et cetera. Corporatism is certainly a problem. But that's not capitalism, right? Capitalism and and most importantly, it's the American dream. What is the American dream? I want to be able to go out and get that American dream. And their view is that the American dream, this was a Wall Street Journal poll. Sorry, this is a little bit small, but the Wall Street Journal poll, 45% believe that the American dream is not even available to them anymore. And that's nearly half the country. And again, it's not surprising when you take a look at the financial markets, and you have 88% of the financial market is owned by the top 10% of income earners, right? That certainly doesn't sound like the American dream is working by any stretch of the imagination. The rich are getting richer, the poor are getting poorer, but those are also because of the decisions that we're making on the things that we do societally. You want more bailouts, you want more support, you want more of this, you want free education, you want free healthcare. All sounds great. Somebody's got to pay for it. And that just continues to widen that divide between the rich and the poor because, well, that's the way economies work. And we've seen this over time is that, this is the inflation adjusted household net worth. This includes your housing, right? Even for the middle class, that 50 to 90 percentile group, their net worth is, yes, higher than it was in 2008, but not by much. Right? Their wealth has not expanded dramatically like the top 10% or the top 1%. Their wealth has grown dramatically. So the reason I bring that up is that you can certainly, understand why people are so deterred by and particularly when what they see going on in the world today with, we started, and this isn't new, by the way, we started in 2008 with, the 99%, right? We had the people picketing on the lawn of Washington, D.C., protesting against the top 1%. And, that was the start of all this. And of course, we've had arguments about we need $15 an hour minimum wage. You should be able to have a living standard based on $15 an hour. And we've gone through all of these things, and they're all very flawed premises, but they're all a structure or a function of the oppression that people feel financially because of what we've done economically to our system, the debts, the deficits, the corporatism, the stock buybacks, the making executives uber wealthy. And it certainly seems like the American dream is well out of touch of everybody. But, then you look at somebody like Adam, right, that just left his job, starts a brand new company, and he's building a new company. And that's the American dream, right? He's starting with nothing, and he's building something into what he hopes will be a very successful business. And that's capitalism, right? And capitalism is what leads ultimately to the American dream. What is the American dream, right? We have to define that. The American dream is not owning a house, right? That's the symbol of the achievement of the American dream. That is, Adam builds a business, he becomes successful, he creates a lot of revenue. He rents a house right now. So when he creates a lot of revenue from his business, he says, hey, I can now afford to go buy any house I want. That's the American dream. That's the American dream is not the house, right? That's just the symbol of the achievement of the American dream. So we need to focus on the things that we can do. And so I go through this article and I lay out 10 steps, right? And this is 10 steps that I try to teach my kids, every day. And I send them videos and I send them articles of people I admire that have created a tremendous amount of wealth in this country. It's very possible. It's very sustainable. It's very doable. but you got to be accountable for your current situation. I mean, so many people come to me as like, well, you know, I'm in debt up to my eyeballs and there's just no way that I can ever do any of this because, you know, it's just, you know, my life sucks. And okay, I get it, but be accountable for that. How did you get in this situation? Great. How are you going to get yourself out of it? Start there, right? And this is, and you have to believe that your life depends upon your success. And that's rule number 2. Your life depends on it, literally, right? So I'm going to make this business work regardless of the cost. I'm going to sacrifice everything to be successful at this business. And you look at entrepreneurs that have become uber wealthy over time. That's what they did. They started with nothing and they committed their lives to making this thing work. Did they fail along the way? Absolutely. Did they quit? Never. And you have to be able to be willing to do that. Commit to the job, commit to the business, commit to the structure, commit to the idea, and do it no matter what. Control your circumstances around you. You have to really want it. And this is the problem with most people I see that start a business. The first time they hit a road bump, it's like, well, it didn't work, so I quit.
Yeah.
You didn't really want it, right? You didn't really want it if you quit at the first road bump. You got to be bold. Nobody's going to take you seriously if you're not serious about yourself and you're not serious about your job. You know, you've got to find a guide. And you know, Adam talks about finding a mentor all the time. Find people that have done it. Find people that have been there. Go ask them questions. Be willing to work for them for free. Say, you know, let me just tag along your coattails. I want to do this someday. And I have a friend of mine that I do that with, and I help him all the time. I'm always with him because I'm trying to learn his business because it's something I want to do in the future as well for myself. So find a guide, find a mentor, find somebody that's successful that you respect and that you'll listen to. And, you know, and decide whether you're a renter or an owner, right? Renters can walk away without consequence. You know, and I'm not talking about home ownership here. I'm talking about business. You know, in business, you've got to decide if you're an owner or a renter, right? If you're an employee or a renter, you can quit any day and walk off. If you're an owner, you don't have that choice if you're going to be successful. And again, this goes back to being committed. You know, if you've got no choice but to succeed, you'll succeed because you don't have any other choice. And you got to be willing to work. You got to work 8 days a week, 36 hours a day. And if you're not willing to do that, don't even start. And then you probably need to get rid of all your friends. You know, there's a great saying. I tell my kids this every time they bring one of their friends home that they shouldn't be around. I'm like, look at him or her. Is that where you want to be in 5 years? And they're like, no. Then why are you hanging around them? Because the friends you have around you today, the people that you hang out with, it's where you're going to be in 5 years. If you don't hang out with successful people, you're not going to be successful in 5 years. They're going to drag you down. So look at your group of friends and change your group of friends, build new friends and build new relationships. And most importantly, get off social media. Ain't nothing good happening on social media. Turn off YouTube, turn off social media, get to work, because that's where, sorry, Adam, I know you're trying to make your business on YouTube, but for most people, you know, get off of these platforms because they're not helping you. They're not educating you. They're not feeding you. They're not helping you create. They're wasting your time. And if you're spending 4 or 5 hours a day on social media, that's 4 or 5 hours a day. You're not committing to building your business. So the American dream, it's not dead. You just got to go out there and get it. And you have to start today. So there you go. That's my rant for the day.
Wow. Well, Lance, that's fantastic. I have so much to say about everything you said there, but I didn't want to interrupt. You did a phenomenal job. So first, let me applaud you for that. Wonderful. I'm going to send that to my kids as soon as I get off this. Folks, if folks want to get that and read it or send it off to their kids, it's realinvestmentadvice.com.
Yep, absolutely. So it's the article from Friday, top of the post.
Okay. Gosh, so much I'd love to say about that. We'll have to dig into it more deeply maybe next week. I think the one thing I would add to your list there, which is be part of the solutions you want to see. So what you're talking about there is the individual taking control of their destiny in the current world in which we live in, right? It's just, hey, we have to deal with the world as it is, not as the world as we want, right? And capitalism, as you said, that the type of capitalism we have right now really is corporatism, right? Or crony capitalism. We've talked about this a lot. You showed the massive divides in wealth gap, which is continuing to get worse. And to be honest, you know, we are, while it scares me as much as it does you, we are creating the siren song for these, you know, socialist leanings that the younger generation is migrating towards, because they're losing hope. Like you said, half the people have basically given up in the American dream, right? So as individuals, we don't want to assign ourselves to that fate, and so we do have agency in the story, and if we follow your tenets there, we're much more likely to have the type of future that we want. That being said, I feel like we should do what we can to help right the situation and try to contribute our own little piece to trying to make the ecosystem, the environment that we're in, better for everybody, right? And so, in the old days, so many things that are now in the purview of the government were handled by private charities, right? So if you can volunteer, if you can donate your money, your time to causes that you believe in, that you think will help the system, so that maybe government has a little bit less of an opening to step in, right? That's going to be helpful, even if it's just mentoring somebody else or helping the people in your neighborhood. But also, I know people roll their eyes when I say this, but voting, right? I mean, we've had centuries of Americans who have given up their lives to preserve our form of democracy and our ability to actually elect leaders. So, play your role in pushing forth the reforms that you want to see in the system. And if enough people do that, maybe we'll see some change, but we certainly won't see change if we're not, pushing for those type of changes ourselves. So I love everything you had there. I would just put in, be part of the solution that you want to see in the mix.
There's probably another 10 or 20 rules you could put in.
Absolutely. Like I said, I mean, I'd love to actually just lean back and really kick a lot of those ideas around with you. I'll also say too, the thing that one thing that came to mind as you were sort of talking about the ills of the system is, my wife's a marriage family therapist, as I think I mentioned a number of times. And, she sees a lot of couples where the default is, this relationship's getting tough. And, I just want to cut the cord and there's somebody new who's bright and shiny out there, right? And, leave the marriage for the affair or the what looks fun and convenient at the time. Generally always is a worse decision, right? Not that there aren't relationships that you shouldn't get out of if they really are bad, but long story short, your long-term returns are definitely much better usually if you both work on repairing something that at its foundation is good or has the potential to be good, right? And I think that's the same thing in our economy and our society here, which is we shouldn't reject capitalism. We should just be sitting down with it, with the therapist and saying, hey, capitalism, how can we get this relationship to be a more constructive one with us again? Because it was so great, back in the day.
Well, no, and I think the key point there is too, and you're absolutely right, is that we get so wound up in the headlines about Apple or Microsoft or Google or these corporate executives, and we're so wrapped up in this what the 1% is doing, that we lose sight of the fact that there's nothing stopping us from going out and building the next Amazon or the next Apple or the next Google. There's nothing stopping anybody. 10 years ago, there was no such thing as an electric vehicle. And this guy shows up and he builds an electric vehicle, and now he's the world's richest man. There's nothing precluding you from doing that. And I think that's the overriding message that I try to tell my kids is like I know there's all these barriers that seem to be out there that are going to keep you from being successful. You're just going to have to climb over all of them. And you're just going to have to force your way through, and you can be successful, but you just got to be willing to do the time. Right?
Well, do the time and to persist through discomfort and to take on adversity head on. And this is actually my rant that we keep pushing, right? Yeah. And maybe I just need to push that adversity and make a start with it next time around. But I think so much of what is causing the loss of hope at the personal level in this country, depression, anxiety, all that stuff, is the fact that we have overprotected ourselves, and I think in particularly our children, from anxiety, which is actually the world's greatest teacher. And it is the path, as you and I have talked about the Stoic philosophies in the past. The obstacle is the way. If you, and I'm happy to expound on this later on, but like that was the mantra in my mind as I made my transition from my previous company to now launching Thoughtful Money. Was literally, once I decided that a change needed to happen, what made it all possible was me just taking head on the obstacles that I had been trying desperately to find ways around or how to manage, and to say, that's not solving the issue. I actually need to just go straight through this thing, right?
And
But
that's something like we raised our kids that way. Where a lot of parents were trying to shield their kids from, adversity or whatever it was. We shoved our kids right into it. So, and it's paid off. They're all very strong. They're very independent. I don't have to worry about them. They're good kids. They don't do drugs. They don't drink. They don't, get in trouble because, we never sheltered them from the bad things that are out there. We let them face it, head on. And I think it paid off. And a lot of people disagreed with us at the time, but I think the results speak for themselves.
yeah, my kids, famous in town for painting us as the strictest parents ever in Northern California, but I think we're glad we were. And the thing I want to make really clear about this is I'm not coming at this from an angle of, and this is how you're going to make more money. Now, I think you will, because I think it's a byproduct of the success you'll have by learning how to overcome adversity. But really, I think it's much more about meaning. I think it's much more about, getting fulfillment out of your life, which I think is really increasingly lacking in the dangerously large part of society here. And as I often say, if you are finding ways to identify your purpose in life and orchestrate your life around it, the money may come, the money may go. There's no guarantees around that stuff. But if you're waking up every morning and you are doing things with your hours on this earth that fulfill you and that you believe matter, then you've already won life, right? Yeah. And actually, a lot of these other, material benefits will likely come along hand in hand with that. But you're going to care less about them, to be honest. I was just listening to an entrepreneur who said basically that the more I succeeded in my business, the more it actually less became about making money. And it really just became about making the difference in the world that I wanted to make and the things I wanted to learn, right?
No, if you set out to do this only for the money, you're going to fail, right? If you set out to do something you love to do, there's old saying, if you do something you love, you'll never work a day in your life. That's the true statement. I love what I do, right? I love my business. I have no trouble working 18 hours a day in my business if I need to, because I love doing it. I love the writing. I love the research. I love talking to people. I love, all that. And I wouldn't trade a minute of it. And the money's really very secondary. I would do it for free if I could afford to eat, but it's unfortunately that doesn't work that way. But the money will come if you're doing something that you're passionate about, you truly love, and you're doing it with honesty, and you're doing it with forthrightness, and you're doing it to help others. And that's always been a core tenet of our business. It's always been about service first, helping others. We do a lot of work for people for absolutely free just to help them. And we're happy to do it because that's our way of giving back. We don't have none of us in our business and RA Advisors has the time to go and donate a bunch of charitable time to doing things around town. So the only thing we can do, or one thing we can do easily, is help people that need help. And we're always happy to do that. But it's just a function of that's our business. And I think once you establish yourself that you're doing this because you want to do this and as what makes you happy, the money just becomes a byproduct of that.
Well, and it's that alignment of integrity and customer focus, Lance, which is why I have you as a partner for Thoughtful Money here. I mean, it just speaks very well to the whole reasons why important reasons why I chose your firm and you specifically. Look, I got to get you out to get you to your holiday party there. One last point on this, and then I'll wrap up. So I can't remember if I mentioned this on this program or not, but when I was at business school, there was a class everybody fought to get into because the professor had these great guest speakers and he wouldn't announce them beforehand. And I walked in one day and was shocked because my grandfather was standing there. And the weird part was he had died 2 years before. So it's like, what's my grandfather doing here? And then I realized, oh my God, that's not my grandfather. That's Warren Buffett. And I didn't realize how much they looked alike. But turns out once I met Buffett in person, he actually looks an awful lot like my grandfather. But it was Warren Buffett. And, totally out of the blue, hadn't been announced. And we got to sit with him for an hour and a half. And he said, look, I didn't bring any notes. I'm just here. Ask me any questions you want. And one of the things I took most from that was what you just echoed there. And I know the advice sounds kind of corny, and yeah, a billionaire is saying this, so easy for him to say. But he basically said, stop, working for the resume. We were all young, aggressive people at the time. He said, don't do something because you think it's going to look good to somebody else. Just find what you want to do. Find the thing that you would do for free, and then just figure out how to get really good at it. And you follow that simple recipe, and you're going to be happy in life, and you're probably going to be wicked successful at it too. So, if you don't listen to Lance and I, maybe you'll listen to Warren Buffett there. And in terms of just, how busy we are and the work it takes to do all this stuff, I just want to, I'm going to give a couple quick updates about some of the progress that Thoughtful Money's made. But one of the things I'm not sure folks realize that go on is, all the stuff that happens in the background in between filming these interviews. There's the starting up of the business with all that stuff. And I whined about that a few videos ago, so I won't whine about that again here. But there's a lot of business setup stuff, obviously. There's all the mechanicals of the scheduling the guests and the editing and getting all that stuff out there. There's all the running of the business, which nobody sees. But there's also like there's a securities licensing exam that I got to be taking to make all this stuff happen too. It's a really thick book. And I got to tell you, this is really, really boring, right? And it takes a lot of hours, which I don't really have. So I'm just trying to steal it, from wherever I can. Point is, to do something worthwhile takes work and it takes efforts, but you do it because the rewards are that much sweeter. Because, to do anything, to enjoy anything that's worthwhile, you have to put in the investment to be able to get it, right? So anyways, Lance and I are just basically saying, hopefully we're modeling for folks here that might be at a point in their lives where they're like, you know what, I don't love my job right now. I'd really like to change my situation. And there's a lot of wrestling that goes before that. I certainly did it myself before I made this latest career transition. Hopefully we're giving some folks there the confidence and the inspiration to say, you know what, okay, the obstacle is the way. I am going to lean into this stuff. I'm going to get comfortable with adversity. And I guarantee folks, if you do that and you follow the steps that Lance laid out there, your odds for success are very, very good. Okay, and wrapping up here, just want to remind everybody about the Felix Zuloff interview. That is tomorrow. And so after you've watched this video, again, if you're watching it 24 hours after it's launched, you can probably go watch the Felix one right now. I also want to put this little win up on the screen, if I can do it for folks, just so we can all cheer it together, which is that as of this recording, Thoughtful Money is, as of yet, less than 30 days old, and yet we have already passed over 1 million views on YouTube. I want to say a huge thanks to everybody watching here who's helped make that possible. That chart I just put up is actually, I think, from a couple of days ago, so we're like 1.2 million right now. So a phenomenal start to this new channel, and again, that is due entirely to the folks watching this. So thank you so much for your support here. If you are enjoying these weekly market recaps, really glad they're back. Can't wait to rush out the door and give Lance's top tenets there to your friends and family. Do us a favor, hit the like button, then click the red subscribe button below, as well as that little bell icon right next to it. While Thoughtful Money is still this new, its growth and subscriber count is really helpful in getting the attention of the YouTube algo. So to help us hit even higher heights, please do hit that subscribe button if you can. Last reminder, coming next week, we've got Felix, like I mentioned, but then we have Alf Peccatiello talking about bonds. We've got Rabobank's Michael Every coming onto the program. He'll be giving us sort of his global view of the economy because he's located out in Asia. So we'll get an ex-US view. We also have Cameron Dawson, who will be joining us for the first time. And just want to let folks know, I finally did manage to lock in Lance Simon White from Bloomberg. So awesome. He'll be coming on the program. And then Stephanie Pomboy, who I get emailed about like every single day by all the viewers here, is indeed coming back on the program, locked in a date for her for early January. So for those of you who have been screaming for more Pomboy, you're going to get her soon. Quick reminder that I've returned to the practice of writing up my notes that summarize all the interviews that I do on this channel. So all the interviews that I've done so far, as well as everybody else who I just mentioned, if you go to adamtaggart.substack.com, sign up for that Substack, and then if you want to get the notes, you can upgrade to the premium there, super cheap. It's only like $8 a month. You'll be able to get all my notes for everybody that I've interviewed on this program or will interview going forward. Lance, my friend, I'm going to let you have the last word here.
If you want the article or our latest newsletter, go to the website, realinvestmentadvice.com. You ask questions, comments, emails, always happy to answer them all. I answer every email every day. So if you have any questions, always happy to answer it. Other than that, have a great weekend.
All right, folks. Lance, have a great holiday party there. Everybody else, I'm sure we're entering that part of the season where you're going to holiday parties too. I hope you're looking at a great holiday season with your family. And I mentioned that interview with Danielle DiMartino Booth. If you haven't watched that one, I'll put up a link to it right here so you can watch it after this. Lance, thanks so much again for another great week, buddy. Everyone else, thanks so much for watching.